Good morning, ladies and gentlemen. This is Clueless A Trading Frank. It's a quick pre-market AM report on markets and certain stocks that are on our trading books. Currently, June 8th, 2016. Beautiful morning out here in the New York, New Jersey area on the waterfront. And I wish you all well. Markets and trading are mental businesses. You wake up with a fresh mind. You start off a fresh day. And it really doesn't matter what happened the day before. You can change the whole fate and the P&L of your book by doing the right things with a conviction and a convicted mind the next day. That's the way I look at life. That's the way I look at trading. It's simple. It's tough to do. But you know what? Anyone can do it. You just have to keep on grinding at it, and persistence does pay. So that's my 2 cents when it comes to getting the job done. Let's get straight into the technicals. Before I forget, today is a huge day in Europe. The ECB, the European Central Bank, bond buying program, and I mean a corporate bond buying program, just commenced. It started off early this morning, European time, and it is in full blast right now. Now, it doesn't mean they're buying every single piece of commercial paper that's out there, but they're certainly out there boosting the liquidity of a large number of corporate bonds, which might not be as liquid as normal in normal markets. You want to know about it? There's a fantastic article that I put out on Twitter earlier this morning, and that says that was put out approximately 2 hours ago. And the headline on that is Corporate Bond Markets Poised for ECB Buying Boost. Whichever way you slice it, keeping politics aside, opinions aside and such, anytime you have a QE liquidity program, a quantitative easing program, such as the ones that we have had here and then eliminated last October, you have to keep in mind that there is initially a very warm reception. Quantitative easing in itself is a law of diminishing returns. In other words, it goes on for a while, it boosts asset prices, it does things, and then the underlying assets itself have to take on off on their own. If they don't take off on their own, more QE basically is a law of diminishing returns. You keep on doing more, and you get less and less out of it. Okay, it's as simple as that. The same thing applies in life. If something, initially you get a boost, you take a shot of B12, you get a boost. But after a while, you keep on doing that. If you keep on popping too many pills, whether it be, body muscle boosting steroids or whatever, after a while, it's a law of diminishing return. You're going to get sick, and, bad things are going to happen. Same thing happens when it comes to quantitative easing, okay? Just the way it is. The underlying assets have to take over. Underlying user demand, i.e. consumption demand, has to rise, and that's how economies flourish. So for that to happen, you need fiscal policy changes, which has to come from the governmental side and the political side, and not from the macroeconomic prudential side, which is central banks. It's really as simple as that, okay? Central banks can only do so much. After that, you got to take, there has to be stuff, real boots on the ground, as we like to say, from the fiscal side, which comes from the government. End of story. Now, let's take a look at what we're doing here. Here is a chart of the S&P 500 E-minis. We are up about 4 points. But this is a longer term chart spanning back to the highs from last summer, which was where we had a high on the S&P at 2134, and here it is at 2126 on the E-minis. Like I said, 6-7 points for every S&P E-minis is you just add 6 or 7 points to it to arrive at the actual S&P number. So 2126 roughly translates into 2134 or so. 7.5 points, 7 or 8 points above that is where we were where we hit the all-time highs last May. I believe it was May 21st or May 20th. Okay, so here we are grinding along. You can see that. So let's zoom in and just remind a lot of the newer members who are listening to this stuff, because a lot of you don't really remember market history. So let me get my nice drawing tools here. Okay, here we go. So we had some extremely powerful and massive monstrous crashes along the way. This was the huge flash crash back in August of 2015. People tend to forget that, where we dropped the Dow dropped 1,000+ points within minutes. So that culminated into a big volatility dragon bullish pattern with a higher low in late September, and then the massive rally in between corrective consolidation pullbacks, similar to the ones that we're seeing here, which culminated into the highs again back in early November of 2015. We had a wide volatility driven trading range, which in hindsight, if you look back at it, was a downward sloping consolidation channel, which very clearly did not break out, but broke down. And that broke down in mid-December of 2015. And late December 2015, and then we had that big correction in January, another huge correction in February, right? So double bottom at a lower level at 1800 created a powerful momentum driven upswing, and in between corrective pullbacks, and we have quite a few of those, mind you. And the most recent, and these are all consolidation channels. You'll see more and more of these on my charts. These are where it consolidates. You take profit taking. And it's a time of indecision, because you don't know if this consolidation channel is going to break down or whether it's going to break out. But once you see the breakout, you got to respect it. The breakout continues for a bunch of days. That happened in April. After this consolidation channel in the first part of April, we had a breakout after mid-April, and then came the large drawdown in May. This was certainly a large drawdown. We played it very efficiently here at Clueless 8 Trading, and then we had that big breakout, which was shown by these internals, which were showing a positive divergence similar to what we saw here. And my members are very clearly tuned to that, and they know that how many times I've shown these positive divergences. This is not a positive divergence. This is a pure double bottom. Here we have a positive divergence where we hit the same low prices, but the internal suggest a higher low on the stochastics. In other words, the actual selling pressure, or the so-called smart money, whatever that may be, was actually buying on the second dip. So we had a similar situation here in May, broke out, and now we are in this rising wedge and somewhat of a bull flag, as you can see, which in my opinion will culminate at least at a retest of where we were last May, and that would be around the 2134 level. 2134 level on the S&P 500. Now, just because we touch 2134 doesn't mean that we're just gonna crash and die. Generally, what happens is anytime you keep on hitting a floor, right? Keep on hitting it multiple times. Either the floor is gonna hold or it's gonna break down. Try this on your own. You take a hammer, you keep on hitting a piece of concrete enough times, and you're strong enough, that concrete's going to break. So in other words, every time you thump really hard on the low levels, okay, on the floor, and this is all practical, laws of nature. That's it. Newton's laws of motion. A body in motion stays in motion. A body at rest, inertia, the law of inertia. The body at rest remains at rest. As traders, the guys who are lazy, the guys who don't want to learn or do anything, they stay at rest, they complain, they moan and groan, and then when they come in way late in the game, they lose. Okay, you can't be like that. Anyway, let me not divert, get back to this. So here we are with the floor, and you keep on hitting the floor, it's going to break. So the same thing here. We have a ceiling here at around this level. Okay, so the more we punch at the ceiling, it's possible that we break out. Now, breakout doesn't mean we endlessly keep on going higher. And that's where I come in with some very complex technicals and many other things that I look at, and I say, okay, this is the time to basically, keep on going long, or we take some nice tactical shorts and make some serious money. So in my opinion, what's going to happen in the next following 2 weeks, after we get some major turbulence, in my opinion, during the Brexit vote, that's the British exit out of the EU, Eurozone, possible referendum might say yes, and that's going to cause a market shock, no question about it. Short term, it's not going to end the world. The Brits are going to go back to their pubs and keep on drinking their ale, okay? And it's all going to be fine. They still love Belgian beer, so they need to get that in. All kidding aside, the bottom line is the world's not going to end, but the initial shock is going to be hard. So I'm not going to get into that right now, but that's coming, in my opinion, if the referendum passes a yes vote. That the Brexit yes, that was British exit, then you're going to see some major turbulence in the middle of the month. The middle of the month is coming up next week. So you got to gather your profits this week and stash some nice cash away instead of just going out there super long saying, hey, Frank, Clueless Day Trading said we're going to break out the new high, so let me keep on just lumping in. We don't do things like that here. What we do is we protect our profits. We leave some longs out there. We have hedges along the way in the form of S&P, RUT puts, UVXY, and things of that sort. And then we hit hard when we see a big technical breakout. If once we get that washout or whatever we get in the middle of the month, there's going to be turbulence. Then that's when we're real big buyers. We're big buyers at these levels, okay? We were big buyers at these levels. We're not amazingly huge buyers at these levels because you can clearly see here, a child can see this, that we are hitting some tops, and tops are resistances. So you don't want to mess around. Selective stocks, great. Look at our Googl. It's up almost $8. I'm going to look at that in a quick second. $8 right now, $7.50. I called it way lower. Okay? So anybody who's placed in Googl, and I hope many of you are, didn't get freaked out because the stock was only up $1 because the chart showed what it showed. I'm going to show that very clearly right now. So anyway, so once we hit that, if we break out, we could go as high as 2150. That's nothing. That's 20 points above where we were. What the all-time highs are. That means that the Dow's going to be another 120 points. Whichever the case, the low 18,000s looks very likely on the Dow, over the coming 2 weeks. In the meantime, you will get, in my opinion, a sharp, swift 200-300 point pullback to reset. And when I say resets, well, you guys will learn about all that stuff and take the advanced coaching sessions to learn about it more. And that's where we are. Now, on a shorter term basis, let me exit out of here. I don't want to run out of time. I have 3 minutes here on this video. On a shorter term basis, I'm going to be obviously alerting people on a whole bunch of stuff. This is where we are on the hourly charts. We are overbought. You can see that on the stoves, so we might get a quick pullback at the first part of the day or the first hour or so. But then we look back on the 4 hour to get an idea, and the 4 hour at this point is showing that it wants to go higher. These are big money makers. Every single tick on this line can make you money, all right? But you just got to know how to read it. And on the upper end of the level here is 2122 on the E-minis. So that's what you got to focus on. Once we break out of 2122, it's going to be another short squeeze blast. In the meantime, the Darvas box that I use shows you the ranges we might be traveling in, 2106, 2118. S&P players obviously have to track these very closely. And then, of course, you look at the internals. Now, let me bring up Googl here. And these are the levels we're following. Remember, all you need is 1 or 2 stocks to make your day, all right? Or make your week. You know that. So here's the chart of Googl. Let me see here. Yeah, I'll just keep it here. I don't want to waste time. All right. So look what's going on here. We're 739. Look at this candle. This is a very, very defined mathematical algo-driven chart. You can see the candle building. This candle alone is probably a couple of $1,000 for people who loaded up on the Googl calls, or if not a couple of $100 for smaller lots. For people who bought the stock, you're up 8 points, 8.5 points. It's running. I'm sure there's some news out there, but my job is to be a predictive technical analyst in many cases. And what I saw, I like. So where is the targets? The targets are 743. The first gap fill, second gap fill is around 748, and along the way it's going to chop around. But I love these big fat candles. These are marching soldiers, and soldiers generally tend to march into battle, and our soldiers win the battle. Okay, so that's the way it goes. Buy American, buy Googl, buy Amazon, buy these type of companies. Forget the foreign companies. Now I'm just kidding. Trade whatever you want. All right, so that's it. Wish you well and have a great day. God bless America.